Welcome to the Stock Market Palantir. Today we are going to talk about CLSK. We are dissecting CleanSpark in late 2025, a company that has executed a remarkable operational shift. They just closed their fiscal year 2025, reporting a 102% revenue surge and an impressive swing to a net income of $364.5 million. By all conventional measures, this should be a massive success story. Yet their equity value has faced some significant, persistent headwinds, resulting in a sharp and frustrating price dislocation for many investors.
And that dislocation is precisely the subject we need to unpack. The central paradox here is the collision between, undeniable operational success and these extremely complex structural market forces. The core question for us today is whether the recent stock price volatility and the persistent drop are merely a temporary technical market structure anomaly, a short-term side effect of the massive $1.15 billion zero-coupon convertible note issuance, or if this price action reflects justified, fundamental concerns related to dilution risk, execution complexity, and the long lead times inherent in their strategic AI pivot.
I'll be arguing unequivocally that the current price action is purely mechanical. It's short-term market noise manufactured by the specific financial engineering employed, namely convertible arbitrage. And this noise is completely masking fundamentally brilliant operations and, frankly, an extremely astute capital strategy designed for long-term dominance.
And I will present the necessary counter-argument. I believe the price action is not an accident or some kind of technical error. It is a necessary and rational correction reflecting the high-risk premium the market must place on this massive, complex debt structure. It reflects the structural volatility and the significant execution uncertainty associated with transitioning a business model using such complex, long-dated financing.
Let's start with the operational baseline, because if the fundamentals are weak, no amount of financial engineering can save it. But the fundamentals are exceptional. The market is ignoring phenomenal performance because of a purely mechanical liquidity event. The turnaround is proven. They swung from a net loss of about $146 million in fiscal year 2024 to $364.5 million in net income, which translates to $1.12 per share. Crucially, adjusted EBITDA hit $823.4 million, a 235% increase year over year. You just can't argue against that kind of operational velocity.
The scale is indeed massive, and I do acknowledge the magnitude of that growth on an absolute level. However, if we're analyzing price dislocation, we have to look at how the market reacted to the release, not just the raw numbers.
And the efficiency adds to the thesis. Despite the Bitcoin halving event, which effectively cut their block rewards in half, they still managed to produce 7,873 Bitcoin in FY 2025. That's a 10.9% increase year over year. This is a testament to achieving 50 exahashes per second and successfully consolidating scale. Now, regarding the source of the short-term pain, that $1.15 billion note, I maintain this is genius. It is what I call free leverage. It carries 0% interest until 2032. They secured this capital to build out their massive 1.3 gigawatt AI infrastructure pipeline without having to liquidate their $1.2 billion BTC treasury. And on top of that, the concurrent $460 million share repurchase retired over 30 million shares, showing management's conviction and a proactive attempt to mitigate future dilution.
I see why you think that. But let me give you a different perspective. The selling is mechanical, yes, but its impact is fundamentally justified by the high-risk premium assigned to the structure. We have to first address the technical failure that triggered the selling algorithms. While the year-over-year growth was staggering, revenues at $766.3 million and EPS at $1.12 technically missed the consensus estimates. Analysts were looking for, $783.9 million and $1.45. In a hyper-efficient, algorithmically traded stock like this, any variance against consensus, regardless of the quality of the year-over-year performance, it just triggers automated sell programs. That's the reality of the modern market.
But that's just chasing headlines and feeding the algorithms. It has no bearing on the long-term infrastructure value.
It has every bearing on the short-term price, which we are debating. And let's discuss the core structural problem here, the guaranteed suppression mechanism. When hedge funds purchase a massive zero-coupon convertible note, they're buying a complex security. To hedge the risk that comes with the equity component of that note, they must achieve what's called delta neutrality.
Right, which means they have to hedge their exposure.
Exactly. This means they are they are mandated to immediately short the underlying stock. This is not directional betting. It's required risk mitigation for the arbitrage trade. This mechanism resulted in hundreds of millions in forced selling pressure, confirmed by the massive dark pool volume spikes. We saw 53.34% off-exchange short volume on November 25th alone. This price suppression isn't temporary noise. It's an immediate, unavoidable, structural consequence of the capital raise.
But that pressure is, by its very definition, finite. It's limited to the size of the hedge needed for the principal.
It carries a severe immediate cost to the equity price. And finally, the AI pivot you championed, while strategically genius, offers no immediate relief. Revenue from the new Houston and Sandersville facilities, which this $1.15 billion is bridging, is not expected to be material until late 2026 or fiscal 2027. That's a 2 to 3 year gap where the debt is on the books, the short sellers are active, and the market is pricing in immense execution risk. I come at it from a different way. The market is struggling to price this power premium due to immense operational complexity and a deferred payoff measured in years.
I think the interpretation of this debt structure is where our debate truly starts. You frame the debt as a justified risk, but that requires us to dissect the transaction, which brings us to Clash 1, interpreting the capital raise. Is this transaction truly value creation, or is it the start of a dilution panic? I see the zero-coupon note as the defining element of their long-term strategic value. This capital raise is fundamentally allowing CLSK to shift its entire valuation paradigm.
How so?
Well, right now they trade as a low-multiple Bitcoin miner, maybe 3 to 5 times EBITDA. By securing 1.3 gigawatts of power capacity and converting it into AI data center infrastructure, the goal is to shift that valuation base to that of a high-multiple AI data center REIT, which can command 20 to 30 times EBITDA. The zero-coupon note is the fuel for this arbitrage. And furthermore, that $460 million buyback, retiring 30.6 million shares, was a crystal-clear signal of disciplined leverage. It effectively neutralizes the net dilutive impact until that conversion price of 1916 is actually hit, mimicking the highly successful MSTR capital playbook.
That's a beautiful aspirational narrative, but it ignores the reality of the transaction's immediate mechanics. I challenge the term free leverage. The lack of an interest coupon isn't free. It's the price they pay to the institutional investors for buying a complex volatility instrument. In essence, the convertible note is a long-dated call option on the stock, with a conversion right at 1916. What we saw immediately, however, was the profound negative psychological impact on the retail investor base, what we've dubbed the dilution panic.
But that panic is based on a misunderstanding of the mechanics.
Exactly. Sentiment divergence and information asymmetry made the stock highly volatile. When retail investors see the stock drop 30% after a massive raise, they don't stop to differentiate between mechanical shorting and future equity conversion. They just see dilution confirmed, validating their worst fears about capital structure changes. This emotional reaction is a very real factor in pricing.
And that distinction is absolutely crucial. We have to make it clear. The mechanical selling is the arbitrage hedge funds establishing their delta-neutral hedge today to protect themselves against volatility. That selling pressure is forced and immediate. The actual equity conversion, which would cause long-term dilution, is a contingent event several years out, and it only occurs if the stock price rises significantly above that 1916 conversion threshold. You can't conflate the two. One is structural hedging, the other is contingent dilution.
I agree they're different, but the arbitrage hedge forces the stock downward, making it harder for the company to ever reach that 1916 conversion price naturally. It creates a negative feedback loop. This structural manipulation is precisely what leads us to our second point of contention, the evidence of market pinning and dark pool activity.
Let's examine that evidence.
The granular data confirms institutional dominance and this pinning mechanism. We already noted the off-exchange short volume spiking over 53%. This confirms that arbitrageurs are actively pinning the price to satisfy their hedging requirements. For our listeners who may not be steeped in this, pinning means the arbitrageurs, having sold short to hedge, benefit most when the price remains in a very tight range. They are structurally mandated to maintain selling pressure to overwhelm any positive momentum until their hedge is perfectly established.
I don't dispute that dark pool activity is the mechanism of the suppression, but your argument fails to account for the terminus of that activity. I argue that this forced selling is demonstrably finite. Once the arbitrageurs have fully set their hedges for the $1.15 billion principal, the mechanical selling pressure will dramatically abate. We need to look at who is facilitating this deal and why.
And who is facilitating it? Banks? Acting as agents?
Precisely. Look at the institutional footprint data. Goldman Sachs increased their holdings by 664% and JP Morgan by 62%. These banks are involved as underwriters, facilitators, and agents for the deal. They are service providers, liquidity providers, not directional bears betting against the company's long-term future. Their involvement confirms the institutional appetite for the structured product, not a rejection of the underlying asset.
They are locking in a guaranteed volatility trade, forcing the price down in the short term to ensure their short hedge is profitable while they hold the protected bond instrument. You can't just dismiss the effect because their motive isn't malice. The effect is price suppression.
But we have to balance that against the long-term holders. BlackRock and Vanguard, the titans of long-term capital allocation, maintained or even increased their positions. They provide a massive long-term floor under the stock. And critically, let's look at the options market, which prices future expectations. The put-to-call open interest ratio is currently 0.36. For those listening, a ratio below 1 means there's higher open interest in calls than puts. A reading of 0.36 is overwhelmingly bullish. It indicates that sophisticated options traders have a vastly higher conviction in a rise than a fall, despite the structural shorting pressure we're seeing today.
That is a very compelling counterpoint. It confirms that institutional participants view the stock not as a fundamental collapse, but as a high volatility opportunity that should ultimately trend upward. But this reliance on future potential brings us back to execution risk. Let's move to Clash 3. Operational velocity versus execution reality.
I would stress that the operational velocity they've achieved is the guarantor of their success. Efficiency is no longer just a goal in the post-halving era, it's a prerequisite for survival. The deployment of 19,000 S21XP immersion miners operating at a highly efficient 13.5 joules per terahash, that insulates their gross margins against rising energy costs and Bitcoin volatility. This intense operational discipline is the bedrock that secures their success, regardless of any short-term price dislocation.
You're focused on the quality of the machinery, but let's look at the financial consequences of the halving despite that efficiency. You mentioned their success in production, but the average cost to mine a single Bitcoin rose dramatically to $42,956 in FY 2025, a staggering 100% increase year over year. That increase is due to the halving in network difficulty, not inefficiency. While margins held at a respectable 55%, that was entirely reliant on the Bitcoin price appreciating significantly. Their average revenue per Bitcoin was around $98,000.
But their strategy is to capture that price appreciation through their massive HODL position. That $1.2 billion BTC treasury is the strategic asset, insulated by the 0% debt.
Exactly. They are relying on BTC price appreciation to neutralize the halving impact, which remains a fundamental and unpredictable risk to the core mining segment. The AI pivot is supposed to de-risk them from this reliance, but this brings us back to the capital lockup. That's a compelling argument, but have you considered the length of time the capital will remain locked up before the AI revenue is material?
We know the facilities are coming online.
We are talking about $1.15 billion tied up until late 2026 or 2027 before the Houston and Sandersville facilities are energized and start generating material AI-related hosting revenue. The market is pricing the risk of execution failure during that 2 to 3 year transition period. That is why the stock is heavy. Infrastructure plays are inherently slow, capital-intensive, and prone to delays. This zero-coupon capital raise makes that cost and that risk explicit to the market.
I disagree on the interpretation of the asset. The immediate value is in the 1.3 gigawatts of secured power capacity and the land assets today, not the revenue tomorrow. Data center valuation is primarily driven by secured available power. That capacity, which they secured at a near zero cost of capital, is the asset the high multiple market will eventually recognize and price into the stock.
And the market right now is telling us that the cost of securing that long-term optionality is immediate structural suppression and a 3-year execution premium. I think we have reached a clear divergence on the time horizon.
Absolutely. For me, the CLSK story in late 2025 is a deliberate, strategic swap. They are consciously trading short-term equity stability, which has been temporarily disrupted, for long-term asset dominance in the critical power and AI infrastructure space. The current price is a temporary mispricing of this time horizon. The market must eventually price the infrastructure play, recognizing that the 0% debt is a phenomenal competitive advantage.
And I maintain that the price dislocation is a necessary signal. It highlights the complex dual risk associated with transitioning a business model using massive structured debt, particularly debt that structurally mandates selling pressure. Investors must carefully balance the undeniable operational successes against the structural volatility and the deferred materialization of the AI vision, which won't be realized until fiscal 2027. We clearly see that the source material presents a divergence in interpretation, emphasizing that understanding the mechanical effects of financial structuring, the arbitrage, is just as crucial as analyzing the underlying operational fundamentals.
The short-term pain is hopefully the necessary catalyst for the long-term gain.
Provided they execute perfectly over the next 36 months.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.